This year, we are witnessing the largest round of initial public offerings in financial history. A batch of highly familiar super unicorns is finally hitting the public markets, and some of them are debuting with potential $1 trillion valuations. But if you dig into the data behind these companies, you will spot a massive change in how capital operates today. Wall Street is currently pricing these companies based on exactly where they are heading, often moving past their current bottom line. To see this behavioral shift in action, look at what Walmart did earlier this year. They officially delisted from the New York Stock Exchange and moved over to the Nasdaq. They had simply had enough of being defined as a supermarket that solely sells toilet paper. This chart tracks Walmart's stock price over that transition. Notice the flat trajectory during its NYSE era, followed by a sharp 20% spike. That jump happened precisely when they repositioned their corporate narrative from a retailer to a technology company dedicated to using AI to build a global supply chain. That brings us to the core dilemma for investors. At least half of the 10 massive companies going public this year are currently bleeding cash, yet their valuations are skyrocketing based on their vision. When a company stamps its vision on an entire era, history shows they develop into absolute giants. Look at Microsoft mapping out the personal computer era, or Apple doing the same for the mobile transition. Today, you are facing a similar technological leap. You have to learn how to separate the legitimate world-building visions from the multi-billion-dollar hype traps. Let's rank these 10 unicorns so you can avoid destroying your capital and actually capture this wealth transfer. This 3D quadrant chart maps out our evaluation framework. We are plotting investment risk and volatility on the x-axis against the strength of a company's moat and vision on the y-axis. We will start at the very top right with the absolute titans. First is OpenAI. They just closed the largest round of private financing in history, taking in $122 billion, even while operating at a massive loss. That valuation is validated by the heaviest hitters in global capital, including $30 billion injections from giants like Amazon, NVIDIA, and Masayoshi Son's SoftBank. These investors are paying up because CEO Sam Altman's goal is artificial general intelligence, an infrastructure so capable it could reshape the global economy and potentially realize universal basic income. But that ambition comes with a trade-off. OpenAI commands unmatched consumer traffic, putting them directly in the crosshairs of intense global regulatory scrutiny. That vulnerability opened the door for their mortal enemy, Anthropic. Founded by a former OpenAI executive who prioritized strict safety boundaries over rapid consumer release, this bar chart reveals a massive reversal in the enterprise sector. By the end of 2025, OpenAI's corporate market share dropped from 50% down to 27%, while Anthropic surged from 12% up to 40%. Anthropic completely missed the initial consumer praise that made ChatGPT famous. By focusing heavily on data safety instead, they locked in highly lucrative, deeply entrenched institutional clients like Pfizer and major sovereign wealth funds. Moving beyond software, we have to look at Elon Musk. He has interlocked his entire ecosystem of companies to serve one massive entrepreneurial goal. Starlink, xAI, and the Optimus Robotics division are integrated infrastructure designed to solve communication, computing, and labor for colonizing Mars. This pie chart illustrates the reality of that execution. In 2025, SpaceX commanded 85% of the total global space payload, dwarfing all national space agencies on Earth combined. That near monopoly on orbital logistics and the physical engineering behind their massive Starship platform is exactly what backs their $1.75 trillion valuation. They have systematically lowered the cost of orbit down to $80 a kilogram, effectively building the exclusive transport gateway for the next century of space logistics. These three titans, OpenAI, Anthropic, and SpaceX, carry the highest capital risk purely due to their staggering scale. But they offer the only true exposure to the infrastructure of the next era. If we zoom back into our quadrant chart and look at the top left sector, we find the superior powerhouses. These companies are solving specific, highly profitable niches with strong moats. Take Stripe. The Irish founders used a pure coding mindset to bypass traditional banking. By embedding their payment code flawlessly into massive shopping platforms, their clients' entire operating systems become locked in. Once a business integrates Stripe, they practically cannot leave. That structural moat is why $1.4 trillion in cash flow ran through their software last year, solidifying their status as the central bank of the internet. Then there is Databricks. Before any major corporation can use AI, they need clean data. Databricks takes raw, chaotic corporate information and refines it so AI models can actually process and learn from it. They boast massive adoption, serving 60% of the Fortune Global 500. However, their core algorithms are open source, meaning tech giants like Google or Amazon could eventually replicate the same service. Canva approaches their moat differently. Their vision is to democratize design. By solving the extreme complexity and cost of traditional software like Adobe, they've quietly built a highly profitable user base of 190 million people. Spotting these types of deep consumer and B2B moats before the massive institutions do requires a very specific analytical framework. If you want to learn how to actively identify these structural advantages and evaluate these metrics yourself, click the link in the description to join our SFA Free Stock Investment Masterclass. Now, panning down to the bottom half of our chart, we hit the high-risk traps. These are companies with massive valuations but severe structural flaws or weak moats. ByteDance, the parent company of TikTok, undeniably holds an underlying algorithm that practically reads human minds, pushing you content based on behavior rather than active search. But their IPO this year is essentially forced by expiring employee options and strict investor deadlines. You're buying into a reluctant listing facing extreme geopolitical headwinds and intense regulatory pressure from the US government. Next is Shein. They built a heavily digitized supply chain, taking a clothing design from concept to global delivery in 7 days, terrorizing traditional competitors. But that extreme pursuit of efficiency has firmly pinned them as a low-end budget brand and left them constantly vulnerable to massive intellectual property and plagiarism lawsuits. Discord built a $15 billion paradise for digital communities, relying strictly on premium memberships instead of ads. But they remain overwhelmingly tied to the gaming sector, struggling to break into mainstream corporate industries. Finally, Strava holds a massive cultural footprint among athletes, yet only about 2% of their users actually pay for the service. They are terrified to charge aggressively, leaving them with incredibly weak monetization. The hard truth here is simple. User engagement and viral popularity are entirely worthless to you as an investor if a company lacks the leverage to actually charge its audience. Looking across this entire IPO class, valuation is being driven by the future reality these companies are constructing. The actual product or service is often secondary to the scale of the vision. This decision tree outlines capital allocation based on your risk profile. For aggressive growth, target infrastructure titans. SpaceX, OpenAI, Anthropic. Pragmatic compounders target highly profitable moats. Stripe, Canva, Databricks. Regardless of strategy, approach forced IPOs like ByteDance, Shein, and Strava with extreme caution. To build out your personalized IPO strategy, tap the link below and get into the masterclass. The criteria for participating in this cycle have shifted toward vision. If you remain a passive bystander staring at the old metrics, you will be left behind by these new markets. Stop watching the shift and start positioning your capital for it. See you inside.